Here's something that should alarm Meta investors. The company has unleashed a massive tidal wave of AI announcements this month. New large language models, new platforms, new partnerships, and yet the stock basically hasn't budged. We're talking about one of the world's largest technology companies spending billions and billions on its AI push, and Wall Street is just shrugging. It's strange, right? You'd think investors would be absolutely thrilled. So what's going on? Why isn't Wall Street buying into Meta's AI story the way it's buying into Nvidia's or Microsoft's? And more importantly, what would actually make investors care enough to drive the stock higher? That's what we're diving into today. Because the answer reveals something much deeper about how the market actually values AI innovation. And it's not what the headlines suggest. The real story here isn't about Meta's technical capabilities or whether their models are technically excellent. It's about why the market has completely different expectations for different companies when it comes to artificial intelligence. Some companies get a standing ovation for an AI announcement. Others, like Meta, announce something genuinely remarkable and investors yawn. Understanding that difference is the key to understanding where the real money is flowing in AI right now. Let's rewind to June 2026. Meta has been the underdog in generative AI for a while now. Compared to OpenAI, Anthropic, or Google, Meta's been playing catch-up. But this month, they've decided to go all in. They released Llama 3.1, their latest open-source large language model, and it's powerful. They launched new multimodal models. They announced AI search integration. They're pushing AI agents that can take actions on behalf of users. It's an aggressive blitz. From a technical standpoint, it's impressive. Meta's engineering team has built something genuinely competitive with what the other companies are doing. The models are fast. The architecture is solid. They've got industry partners paying attention. But here's the thing, investors aren't reacting the way Meta probably hoped. The stock hasn't jumped. There's no FOMO, that fear of missing out that drives equity rallies. Wall Street looked at all these announcements and essentially said, yeah, that's cool, but so what? That reaction tells us something important about how Wall Street thinks about AI right now. It's not just about technical capability anymore. It's about business models. It's about profitability. It's about moats, defensible advantages that competitors can't easily copy. And that's where Meta's story gets complicated. So here's the core problem for Meta. Llama is open source. That's actually Meta's strategy. They're not trying to lock users into a proprietary model like OpenAI does with ChatGPT. Instead, they're betting that by releasing Llama openly, companies will build on top of it, integrate it, and become dependent on Meta's ecosystem. It's a compelling play long-term, but here's where Wall Street gets skeptical. Open-source models are freely available. Competitors can take them, modify them, run them anywhere. They can deploy Llama on their own servers. They don't need to pay Meta. There's no recurring revenue stream. There's no subscription. Compare that to Microsoft. They own exclusive access to OpenAI's latest models through their partnership. Every time someone uses Copilot, Microsoft makes money. Nvidia sells the chips you need to run AI models. They make billions from that bottleneck. But Meta's giving their technology away. From a business perspective, it's extremely tough for investors to see how that translates into shareholder value long-term. And here's the kicker, Meta's core business is advertising. AI hasn't clearly improved Meta's ability to sell more ads or charge more per ad. That's the real disconnect Wall Street can't overlook or ignore. Let's look at what Meta's actually announced this month to understand the scale of the bet. They released Llama 3.1 in multiple sizes, an 8 billion parameter version, a 70 billion parameter version, and a 405 billion parameter version. Bigger models are more capable, but require more computing power. They integrated AI search into their social platforms. They announced AI agents that can help with scheduling, shopping, and customer service. They're building AI features into Instagram, WhatsApp, and Facebook. On paper, it's a comprehensive AI strategy covering every major product. The problem? Users barely notice these features yet. Adoption is slow. The AI agents haven't gone viral. The search features haven't become must-have capabilities. And critically, none of these moves have directly increased Meta's advertising revenue in measurable ways. Facebook and Instagram are still monetized the same way they were 5 years ago, through targeted ads. AI might make those ads slightly better, but investors haven't seen the evidence yet. Contrast that with what's happening at Microsoft and Google. Microsoft's AI integration into Microsoft Office products is showing real traction. Companies are paying subscription premiums for Copilot. That's tangible revenue. Google is integrating AI into search in ways that could justify charging businesses more for search ads. They are monetizing AI directly. Meta's strategy is more indirect. They are betting that AI becomes foundational to their platforms, but the payoff is vague and uncertain. Here's where it gets really interesting. A quick comparison that explains everything. Nvidia's doing phenomenally well because they control the hardware that AI companies must buy. There's no way around it. You want to train a large language model, you're probably buying Nvidia H100 or newer GPUs. That's a hardware moat. Microsoft paired up with OpenAI early, got exclusive access, and now they're the gateway for enterprise AI through Office integration. That's a partnership moat. Google owns search, billions of queries every day, which gives them unmatched training data and user traction for AI. That's a data moat. But Meta, their moat is less clear. They're releasing open models that anyone can use. That's great for developers. It's great for competition and innovation in the ecosystem. But from a capitalist perspective, it doesn't protect Meta's business. Open source is the antithesis of a moat. It's the opposite of lock-in. Investors love moats. Moats mean pricing power. Moats mean the company can maintain its margins and grow faster than competitors. Meta's AI strategy hasn't yet demonstrated a durable moat that would convince shareholders to bid up the stock. That's the fundamental issue. Wall Street isn't saying Meta's models are bad. They're asking a harder question. How does this actually make Meta more money? What does this all mean going forward? A few critical things. First, it's not really about how good Meta's AI is. Meta's engineering is first-rate and competitive. The problem is the business model. Open-source models commoditize AI. When anyone can download your model for free and run it, you can't charge premium prices. The value changes downstream to whoever can build the most useful application on top. Second, this exposes a real challenge for Meta. Their traditional moat was network effects. Facebook and Instagram have billions of users. That's powerful, but AI is different. In AI, network effects matter less. A really good open-source model is as useful as a proprietary one if the code is available to everyone. Meta can't rely on their social network alone to win in AI. Third, investors are realizing that not every tech company will make money from AI. Some will make enormous profits. Some won't make anything. The winners will be those with clear paths to monetization. Meta's path is muddier than Microsoft's or Google's. That's not to say Meta will fail in AI. They won't. But investors won't pay premium valuations for a company whose AI strategy hasn't proven profitable yet. They'll wait for evidence. And that waiting is why the stock isn't moving despite all the AI announcements. So what would actually move Meta's stock? Here's what Wall Street is watching for. Number 1, clear monetization. Meta needs to show that AI features are driving higher revenue per user. If Meta can demonstrate that AI personalization increases ad click-through rates or lets them charge premium prices for AI-enhanced ad targeting, that changes the narrative overnight. Number 2, defensibility. Meta needs to find ways to make their AI moat stickier. One approach, keep some models proprietary while releasing others openly. Use the open models to build goodwill and adoption, then monetize through premium closed versions. Number 3, enterprise focus. Right now, Meta's mostly consumer-focused, but B2B AI software has insane margins. If Meta can convince enterprises to build AI applications on top of Llama and then charge them for scale, infrastructure, or premium models, that's a billion-dollar opportunity waiting. Number 4, AI-powered products that don't exist yet. Meta needs to invent something genuinely new that justifies the AI investment, not just better ads. Something useful and unique that drives new revenue streams. The company isn't lacking in capability. What's missing is business model clarity. Meta's playing checkers, while Microsoft and Google are playing chess when it comes to AI monetization. Here's what to take away from all of this. Meta isn't failing at AI. Their technology is genuinely solid and competitive. But Wall Street doesn't care about raw technology alone. Investors care about money, actual dollars, profit margins, defensible business models. And right now, Meta's AI strategy doesn't have a clear, proven path to meaningful new revenue. It's costing them billions to develop and operate, with returns that are unclear and distant. That's why the stock isn't moving despite all the hype. It's not that Meta's announcements are bad. They're genuinely impressive from an engineering standpoint, but they're also unproven from a business standpoint. That's the fundamental gap. The question now is whether Meta can close that gap. Can they find ways to monetize Llama and their AI features at scale? Can they build defensible advantages that competitors can't copy? Or will they remain the company with the best open-source technology and the fuzziest business model? That's the story you need to follow going forward. Watch Meta's earnings calls carefully. Listen for numbers that matter. Revenue from AI features, adoption metrics, margin expansion, profitability. That's where the real answer will come. Follow for daily AI news.